Alright, hello guys, glad to have you on board again today. We're going to talk about these types of investor stuff, which is a model that I've built for you to let you understand the basics of what you need to know regarding this. If you are either building yourself a strategy or currently have one, that's the way to go. So remember that the market is the cumulative sum of three factors which are equally weighted in the overall kind of equation of some sort. Is that the market is both technical, psychological, and fundamental. All right, these are the kind of three aspects of the market, call it a three-dimension stuff or whatever, which are always influencing the market with some variable extent, of course, as the time passes. But the thing is that it is a combination of all three at all time, and there's no way for you to remove one of these out of the equation, or you're just getting to chaos. Okay, so prices have a structure when they do have a technical price structure, otherwise that's just chaos. They're generally associated with a market psychology, which can alter the technicals most of the time. And there are also fundamentals which drive the technical structure, okay? So that's really the way to go. They're all interdependent because the fundamentals can act over the psychological state of the market. The psychological state of the market can alter the fundamentals and so on. So you got it all. It's a complex mess. And that's the beauty of it. If there was a simple equation, well, it would all be reached. But the truth is that you need to get better at all these three if you want to progress at getting better as a trader with a big T. So that's really the way to go. There's one you have full control over, which is technical structure, because that's where you can actively learn a strategy. There are no better strategy than the others. It's just that there are so many absolutely outrageously bad strategies by definition. So try to learn at least one good strategy, and remember that one good strategy is just a strategy that removes as much of your free will. Your strategy, be it whatever technical indicator you're using, the best strategies are the one in which you have the least control over your decisions, which means everything you have is limited by some strict boundaries, rules sets that tells you whether you need to do this or that, and needs to have a gradient. There's no strategy that says buy or sell. It's not how it goes. It's buy, but okay, when? Do I buy? For how much? And how do I risk manage this bought asset over time? It's really this thing that a strategy must answer. That's it, okay? So learn it. That's where you have kind of, this is the basis. This is the easiest one to manage. Psychology on its end is generally correlated to experience. That means both the individual psychology, you as a trader, and your own personal biases toward trading are going to put yourself in between what you should do and what you will do. So psychology both at an individual level and also at a market level. What are other investors doing, and is this sufficient to alter the technicals or fundamentals? All right? Perceiving both individual and market psychology is somewhat tricky because there are very, very limited actual measurements of this that are reliable. So most of the time I tend to say I wouldn't trust a beginner into psychological management, neither on its own personal level and also on assessing the market's behavior as a whole. So the more experienced you are, the more you survived longer into this game, the better you would be at assessing both those things. So we tend to say this one is the one you have least control over. All right? So best kind of control, you need to work this one out first. Then kind of understand that this one is, you're going to have to let go. It's going to work itself automatically over time. The third one, though, fundamentals, is important. Remember, it doesn't substitute from any of the other two, and it certainly doesn't have to be put forward ahead of technicals. Technicals is the easiest thing to learn. Fundamentals comes after it. So once you master the technicals is where you start looking for fundamentals. All right? The thing you need to figure out now is that if you start to dive into the fundamentals of markets, well, there's one thing you need to learn is that there are so many fundamentals. So you need to have somewhat of a category of it. And this is what this type of investor thing is doing. It's just telling you that there are, out of the random chaos of all the models that have been ever created in the markets, there are somewhat categories that have been created, and they tend to resonate, as the names you might already know, under some very well-known figures and persons on top of it that you might very well recognize. Like, for example, the biggest, most well-known value investors of all time is, at least for now, Warren Buffett, okay, which is basically renowned for this expertise that it has in the value investing, which is basically, if you think value investing, you immediately think about Warren Buffett. Though there a second category which is defined to be growth, which, well, for example, right now you'll be familiar with, for example, ARK-Invest's Cathy Wood, which is pretty familiar with growth. You would see event-driven type of investors like Carl Icahn, very well renowned for this. They have some specific kind of model systems that guide their decisions, but once again, understand that models are there to guide, to remove degrees of freedom, to avoid having your own personal assumptions, figuring out whether you should buy this asset or this asset. Remember that when you buy one asset, for how much and for how long, or whichever risk management, is the answer of technicals. The answer of fundamentals is, why should I buy this asset more than this one? Because remember, there is an infinite amount of assets out there, or not necessarily, but close to, and there is a limited amount of capital in your pockets. So you need to figure out how to separate one to the other. And that is fundamentally driven type of selection and needs to be modeled as well. Just like you have a model to tell you why and how you trade, this one tells you which one. All right? So event-driven are defined by how do I pick this asset rather than this one, okay? Though Carl Icahn has been very well renowned for macro level type of investment, merger and acquisitions and all sorts of stuff, we're going to figure this one out afterwards. Momentum traders, which is another category which is very well overrated, like a lot, but there are still some very well renowned historical investors that have been very good at doing it professionally, okay? Like, for example, William O'Neill, very well-renowned person of this, has been a lot of model based on momentum, but not shitty models like, yeah, buy the moving average or whatever, or just look at the Twitter sentiment. No, it's really not that thing. Though these guys have been very solid and precise model to guide momentum-based decision-makings, okay? So we're going to review some of these. Another big category is the VC investing, very well renowned. I mean, you might recognize the person. This is Mark Andreessen from Andreessen Horowitz, very well renowned VC in the space, who are using, all VCs are actually using some sort of strategies very well defined as well in their own category of investment. And finally, last but not least, the contrarians, very well renowned in here. You might all recognize Michael Burry, and that's it. So now that we know all the categories, what matters is what type of actual models they tend to use, because there are several momentum investors, VCs, and whatsoever. One thing is seem to be recurring is that they all tend to use the same type of model. Each and every one has some proprietary model, but they all kind of use the same sort of stuff, okay? And that's what we want to take out of this. That means whatever you do, you're very likely going to fall into one of those categories. And if you do fall into one of those categories, they all have existing types of model, and you rather like to try inspire from this rather than thinking you're going to revolutionize the thing out of nowhere. Okay, so it's really what the essence of this today's session is. All right, use the knowledge to guide your own models. And the second thing is that we're going to figure out that it is also dependent into the maturity of the asset, aka over time, as the life cycle of an asset evolves through time, there will be different classes of investor at each given time. And we're going to study this to let you figure out that there is kind of a constraint on what type of strategy you're going to be using at which degree of maturity on the asset you will be. All right? So that's very interesting to figure out, but that's really what we're going to learn today. Though number one key takeaway is to figure out how an asset life cycle tends to behave. All right, so every asset gets listed on one day, but it has a previous existence. Okay, the asset doesn't necessarily start by the day of its previous listing or of its IPO, ICO, whatever. So the number one thing to understand is that there is a life beyond that threshold. And on that thing, it's generally a life that is at a net debt. That means there is still no profit, no revenue generated by the company. Still, there are some exceptions to this rule, but most of the time it's debt-driven, which means this is generally venture capitalists who are into this cycle, who are generally leveraging the money that these project, aka enterprise, whatever that is, just going to use some externally driven cash for expenses in order to deliver a product. When the product gets delivered by the launch, IPO, ICO, whatever, this is where the public journey kind of starts, all right? That's generally the tipping point for VCs. I mean, when the market is listing the asset or when the product starts to sell to the public, this is where the VC find their peak. Though that's a number one rule, that's not a guarantee. Some VC tend to spend more money at a later stage, understanding as a general VC average investment thesis. The reason for this is to understand that VC are actually investing in early stage. They're investing prior to launch. Okay, they're using debt money, which most of the time is going to be defaulted. That means the company itself won't actually pay for the debts and the VC will end up with a loss. So that defines the kind of strategies that you will figure out with VCs. The VCs use power law type distribution, which means 80% of the rewards will be brought by 20% of the assets, and vice versa. So basically, that's the same old prototype distribution in here. The VCs concentrate their rewards on a bunch of assets, and they tend to behave with models that go along with it. They invest early stage into disruptive technology that have high chances to create high beta, and they use risk-adjusted NPV strategies. So you got everything needed on the internet to understand how this works. TLDR is that they have a step-based kind of sequence of events on the lifetime of a strategy that is generally specified to the technical sector in which they occur. So most of the time they know the tech. So when I see people thinking about VCing into gaming with no prior expertise in the domain, it's just fuck. That's not how it works. So VCs are generally technically competent people who use risk-adjusted NPV type structures, which is nothing but just moving average crossover, whatever. Okay, remember, most of the time they're allocating the money pre-listing. So once again, when you see a VC or pretending to be, that doesn't really work out. Most of the time when you see a VC analyzing a chart, that means they're mostly releasing their gains. Remember, that's when they start to profit take, when the asset is listed. Most of the assets will die, and they know that. That's also the reason why they concentrate their efforts on the power law distribution. They concentrate their effort on the 20% that will survive and bring revenue. Okay? Their revenue is certainly not a protocol revenue or whatever. They're just making revenues on selling the tokens, asset, shares, whatever. Okay, so that's really how it goes. It is a short-term based type of investment or time-limited offer, all right? Because they need to sell when there's demand, all right? Who do they sell to? Well, they'll sell to generally momentum traders. Momentum traders are the one that goes after the listing. They're generally going to have to wait for a little bit of time to get awareness, though there is a minimum threshold of awareness which is generally correlated to hype, which means, well, these guys are attracted by momentum, they're attracted by volatility, they're attracted by all sorts of stuff. But this is what generally momentum investors will need to figure out. How do you define those boundaries? Market trends, are you trend traders? How do you define a trend? Remember, you need to have at least a range and breaking out. So that's really the way to go. So first things first, you need to wait for these ranges to build up. I see some momentum traders when the asset goes bonkers till day one. Well, good luck with that. You're going to have to trade volatility this way because there is no trend, okay? The price is always going to be short-term. Though don't do any like weekly, monthly analysis if you're a momentum trader. It just doesn't really make sense. Just go short-term and figure out some short-term price structures. They pay attention to investor behavior, so have some guidelines that define those investor behaviors. How do you define the investor to be in that state or this state? Remember, I gave you the Wall Street cheat sheet the other day. This is one of the kind of things that you can use to frame investor behavior instead of just relying on your own trusts. The market sentiment as well need to be very well defined. Find some indicators that trustworthily figure out the market sentiments, not just I think this or that because I saw this on Twitter, okay? And the technical analysis is pristine. This guy, oh boy, they don't trade like, oh, a triangle broken out or whatever, shit like that. They have very complex technical strategies, okay? So that's the TLDR for them. Momentum traders are trying to build the momentum of the assets as the hype grows against it. The momentum traders are generally selling to unexperienced traders through hype. This is how generally the momentum traders reach their peak investment when the hype is peaking as well. They're selling to unexperienced retail traders or whatever. Okay, they're trying to sell to some other guys. That's the number one thing to understand. The flow of capital in here goes from VC to momentum traders. So you also know what the VCs look for. They look for the momentum traders. So the VCs will generally manipulate price structure, fake out sentiment to try to lure into the momentum traders. Okay, so the VCs build sometimes out of nowhere what the momentum traders want to see, because most of the time the VCs are selling to the momentum traders. They're the exit liquidity. Okay, so bear that one in mind, pay real attention to this. VCs are not your friend. They are most likely trying to lure you into their trades. All right, for momentum traders, like we saw, there are two outcomes. The first one is to sell to dumb traders, and the second one is to try ending the queue by selling to growth investors. All right, the tipping point in here is they rather like to start selling when the hype goes high, because that's where they're going to start losing demand. Okay, and remember that momentum is mostly demand-driven type of assets. So whenever the supply is going to be too violent because the VCs are selling too much and the demand is getting too low to compensate, is where the price will start to crash and momentum trader will take severe losses. Because the only one asking for this afterwards will be either dumb money, buying a market at crashing, or growth traders who will buy it, but at a huge discount most of the time. All right? So think about the exit liquidity for momentum trader is, yeah, you rather like to do it when there are other momentum traders or dumb money around. Whenever the hype starts to fall, you're going to lack of counterparty and you're going to have a problem, which means you're going to end up with something that will lose value over time and you will be unable to sell, which would just fuel the fire further and further. All right, generally, the growth investor look for one particular asset maturity type, which is the peak depth. The peak depth is generally the moment in which the asset, who's been trading for quite some time now, should be generating revenue, okay, not zero revenue, but this is not necessarily revenue driven. The beginning for growth is generally when the peak of depth is reached, which means growth investors generally tend to balance revenue and debt to try figuring out the moment in which it will start to improve the net loss. Remember, the asset is operating at a loss, which means it's fueled by debt. It's going to have to raise its debt over time because the revenue it generates can certainly compensate for the expenses. So right now, expenses are outpacing the revenues, which means the asset operates at a net loss, which further deteriorates over time. Now, growth is going to be when there is a technical signal on these revenue to debt ratios, which is going to start signaling the reverse. That's the first step for growth trader to say, okay, this asset might be worth it. It's still operating at a loss, and I'm going to forecast a potential profit switch. So the growth investors are building their positions, starting there. When the peak debt is brought up, which means the asset itself doesn't necessarily require that much input, it's going to start being able to finance itself ahead of potential eventual profitability. What you need to understand is that the profitability turn point is generally when the growth investors start to wind down their trades. They start to sell. By selling means just selling it to someone else. This someone else is generally the value investors, which starting point of interest is by that point as well. That means value investors generally don't give a fuck about an asset until it reaches net profitability. And certain type of market adoption, which means most of the time value investors don't look for early stage assets and very wild stuff with lots of technical knowledge. The value investors look for existing tech that has proven itself over time, gone way beyond hype and whatever, okay? That's really the way to go. They look for net profitability and profitability sustainability. They look for long-term metrics. The value investors will look for discounted cash flows, and their end game is to maximize profitability. That means they're going to look for peak revenue expectation. They're going to use models to define how much market shares and revenues these company can make, how are their competitors, how are the market shares distributions, all sorts of stuff. And they're going to use this to define a maximum expectable revenue. And by doing this, then they will use a discounted cash flow model to define just how much of this asset they need to invest. And as time passes, they generally tend to improve DCF model, raising their investment on the assets until the peak is reached, when generally the discounted cash flow reach their targets. This is where there is a sustainable revenue, remember, but the best is here. And now only late stage market maturity will be there. By late stage market maturity, we generally tend to see two stages, which is net creditor or peak revenue. That means these are the two stages that generally tend to correlate with max exposition for value investors. Net creditor means at some point in here the levels of debt, which means the level of inherent debt for the company, the debt that the company leveraged for its own operation, is getting to zero and starting to turn negative. That means external debt. Then being a net creditor, you are starting to finance other companies. meaning you have excess treasury and you're going to start making use of it to either M&A, merge and acquisition, or figure out a way to do something with that money, either buy back some shares or whatever. But that's at that point, generally, net creditor means you're going to either absorb other companies or finance some other companies using your cash as a credit environment, which is going to further generate profit, externally driven profit this time around, even if revenue is peaking or even slowly retracting because you reached maximum adoption. All right? So that's really the way to go. Even if the revenue will start to slow down by maximum adoption, you will still have a raise in profit for years to come, generally at the expense of external credit and other sorts of financialization of the asset. All right? And that's the late stage maturity in which generally the long-term investors are slowly but steadily taking profits by the money generated. This is not just selling to someone else. Remember, the value investor don't have to sell to someone. The value investors just take the revenue generated by the company, project, whatever. All right? It's very important to understand. So 2 key takeaways. There are those crossover areas, which are not easy to understand, that dictate whatever the previous ones are trying to fake out to lure in the next one. You know the next one, how they use to value their decision-making processes, and you know all the sequence of events. You also know the timescales. It generally lasts more than 1 to 2 years in the pre-listing phase. Otherwise, VC generally tend to get out. They generally tend to get out entirely when the peak debt is reached, and generally that doesn't last more than a couple of years. So you know that this is. During that time period, the momentum trader will go in. They generally take head start by letting the market trade for itself for a few months, so they get somewhat of a range or whatever, and they break out trade when it starts to improve in terms of momentum. They will trade until the peak of hype and try to find some exit liquidity in dumb money or whatever, and the remainder is going to go to the growth assets. All right? The growth assets are after these massive turning points in this big moment, which is where if there are fundamentals at play, all right, this is where the growth will go in. So this is more psychologically driven. This is more fundamentally driven. All right, this is very important to understand. This is very much short-term oriented. VCs will look for those 15-minute chart, 1-hour charts at the token launch to try figuring out those who are doing well. The VCs are still looking for short-term fundamentals as well. They'll look for the actual activity and the actual revenue, but on a very short-term scale. The momentum traders don't give a fuck about revenue. They all look for price momentum and hype, and they better get out of the market before this hype collapses on itself. And that's really all there is. VCs are basically, short-term trading. Let's say 15-minute, 1 hour at best. Momentum traders will be more like 1 hour, 4-hour chart, rarely go anywhere beyond that. Growth trader will be daily, weekly at best, and value traders are weekly at least, weekly to monthly. All right? They all have different sources for revenue. The VCs need to sell to the momentum traders, and the rest of it is lost in the void because of debt being non-financed and non-refunded. So basically, the VCs have a huge disparity of rewards. Remember, that's what we said before. They are parallel distributed in terms of revenue stream. Okay? The momentum traders who are picking up their air afterwards are trying to build trends in the process of either selling to dumb money or other momentum traders or getting into growth stage, which means they're trying to transform the actual short-term metrics into long-term durable metrics with improvements on the debt to revenue ratios more significantly. So what makes the difference between momentum and growth is actually fundamentals, which means the momentum traders can't create fake fundamentals. Most of the time they try to. That's the reason why I've been raising some alarms recently, but that's really the way to go. Some assets are pure momentum ahead of potential growth, but the growth will need to do the due research because most of the time fake data points will be created for them. So that's really the way to go. This is where there's a big risk between momentum and growth. This is really where most of the assets die. More than 90% of assets will die beyond that stage. Very few assets will pass beyond the 2 to 3 years timescale. They will eventually, and not all of them, reach out to net profitability, which will sign the end of growth investment, the end of those discounted growth revenue module. All right? They will start to emerge into more stable cash flow, DCF model, and the like, because the growth will transfer to value, and not all assets succeed in doing it. All right? You need to understand this. This is very, very critically important. All right? The rest of the others two in here, event-driven and contrarian, will happen generally at critical angle stage. In here, this is where you'll see hell a lot of Michael Burry type of investor who will short the hell out of hype and eventually buy back when they're undervalued of some sort, and they will short and bet. They will sell to growth. So in here, generally the transition to momentum and growth is made by those arbitrageurs with high risk rewards and opposing the sentiment. They are trading either out of favor stocks or selling those who are overvalued. These are the ones that generally tend to do it. Event-driven are generally late-stage maturity. They focus their attention into value trades, and they're generally happening in here, all right? Generally living in between, okay? So growth trader generally tend to sell to a majority of value investor and a little bunch of short-term assessment like that. We do hell a lot of research. Truth is, event-driven, well, like I said, highly professional, highly skilled investors. Very few people are actually in this category. VC as well, highly skilled, lots of pretenders, very few actually succeed over time. Momentum traders, hell a lot of failure. And here as well, lot of pretenders, very few actually doing it. So this is really the way to go. Now you have the landscape of investing. You also figure out all the misconceptions that tells you that you're not doing it right. Last but not least, as we stated, you are probably not a value investor or a pure growth investor. You're probably a mix of all this. By doing this, you also need to understand that there's not a chance you can be equally distributed. You will have favoring sentiments in here, which will get you into weighting more than some than others. And by doing this, it's always better to figure out these kind of Pareto distributions. So if you had to do it, try to fill in the blanks. Say you got a 100 points out of this, and you're going to figure out the first one with somewhat like 45 to 50 points. So in my humble opinion, my case is I would be 45 value or somewhat 50. The second one should be somewhere close to 25 to 30, and I would pull it into 30 growth for me. Okay, like I stated, I would be very few event-driven, and I think the remainder to me would be contrarian. So figure out that you will have that kind of assumption basis as well. You would have a major, a minor, and somewhat of a recurring final stuff in here, which is still non-negligible, and the rest is obviously negligible. All right? So try to figure out what your profit is, and therefore try to build yourself the set of models that you're going to need. In order to know which model you need to use in whichever asset depends on the asset itself. Most of the time, the life cycle of the asset will define which kind of strategy you're going to use. It also defines which time frame you're going to make your risk management on. Remember, your technical risk management, it can't be underlooked. So if you are for example, a VC, you're going to look for assets before they list. When they list, it's too late. Your job should already be done. All that you're left with is a profit-taking strategy. That means you need to define what guides the line of who do you profit take and who do you let it ride. Because remember, most of your profits will be concentrated in a few assets. So if you take these profits on those assets that will perform too soon, all of your rewards will be fucked up. And on the other hand, if you let everyone ride and don't take the profits on those that will quickly ride down to zero, then you're also losing the money that you need to reinforce those who are worth it. Because VC generally tend to sell those who underperform to keep financing those who overperform. And they have models to define that. Those models are the ones we've defined. Learn the risk-adjusted NPV type stuff. That's exactly what guides a VC decision making. All right? As it goes further down, you need to go for momentum. In momentum, pay attention to the unreliability of market sentiment and all sorts of stuff. You need to have professional grade systems to define all of these. Otherwise, you're probably a dumb momentum trader, which means you don't know where you're trading. You rather like to be early, because when you're late to the party, you're going to be the one being the exit liquidity of those who were there before. So basically in here, I've seen very, very few very successful long-time momentum traders, but those who have clear, well-defined guidelines. Then comes the growth, okay, which is very tricky to navigate from one to another. The growth is where the markets switch from short-term short-sighted stuff to long-term fundamental value that can hardly be faked for a long time. Generally, you're going to start switching to daily and weekly charts. If you see no structures out there, get the fuck out of here. And then you do the fundamental analysis. You're going to look for the discounted growth, which the number one metric is the rate of growth in the revenue. And you want to see this growing as well. So this is the second derivative. You want to see the rate of change growing itself. That's really the way to go. And figure out how to build yourself a discounted growth module, to figure out what the asset valuation should be today, to define whether you want to buy it or not and at which price. And that's really how to go. Don't underestimate the technical analysis in here as well, okay? You want to see long shot bets. When you get into a growth investment, most of the time it will take at least a year or two to get to the profitability, sometimes more depending on the asset life cycle. And then it will take years to get out of there. It's not buy, sell, hello, goodbye. It's not this, absolutely not, okay? And there are margins for errors. In the growth in here, you can't get 100% success. So you need to figure out multiple investments in here to diversify the risk. You just don't go like a VC buying 100 of these stuff. There are very much few assets in here. 90% of them are already dead. So you need to figure out those who have chances to survive out of those who are already dead and those who will die afterwards, because out of the improvement in the debt to revenue ratio, certain ones will deteriorate over time and get out of this. So growth will have assessments, and it's mostly driven out of second derivatives of debt levels against revenue levels. You don't just want to see revenue growing if the debt is growing faster. It's really not how it goes. So you need to see genuine growth, not fueled by debt. So once again, if you are just seeing an asset which revenues grows, but on the other hand, they're spending like fucking crazy, that's not gonna make it. It needs to strike on both. It needs to be improvement toward real profitability when they will start locking on the gains ahead of value investors slowly taking in. All right? For longer term vision stuff, discounted cash flow model, which means most of the time the asset price between growth and value isn't crashing like crazy. Generally, most of the time, the volatility is seriously reduced over time as it switches from one to the other. And the value investor picks up at a late stage, discounted cash flow model, and so on, intrinsic value, and that's it. They're gonna catch the assets when they are undervalued according to those models, okay? So a value asset, don't even think it's going to crash 80 or 90% or whatsoever. That would be absolutely outrageously out of assets. And it is defined by being undervalued or overvalued, and this is what defines how the money goes from one asset to the other, and what defines the investment a value investors will make. Remember that at all time. The technicals are here, the fundamentals are there, the psychology plays as well, but there is a very, very limited psychological effect when the value is at play. This is where there is much psychology, this is where there's much value and fundamentals. All right? So very much pay attention to this. Don't underestimate the technicals. Even Warren Buffett looks at a chart. So that's really how it goes. All right? I hope you guys know everything about it now. So try to figure out the strategies you have are applied to certain types of time frames. I don't want you to use a discounted cash flow model on an asset that doesn't necessarily have even 2 years of existence. That doesn't really make any sense. This asset must be almost profitable or already profitable. Otherwise, DCF model, the fuck you doing? All right, that's really the way to go. Models tend to correlate with asset maturity on the cycle, and that's really, really important for you to correlate both. When you are in one asset category, understand that you can very well be good at everything. You're going to be better at some than others, so try to be focused on what you do great. What you do great needs to be backed by a model, and multiple models if you have multiple strategies. You very likely have multiple strategies as well. Just try to figure out which toolbox needs to be applied on which assets. All right? If you want to be heavily specified, like one type of investor, if this is not your time in the market, well, just be patient. There is no growth at all times in the market. There's momentum all over the place, but at some point when the market goes to growth, you need to let go with it, which means you need to change your assets regularly. VCs change all the time. That's really the way to go. Value are long-term, very recurring type investor. They trade the same assets consistently, all right? Time's of the essence for these guys. They trade the revenue. They get the distributed dividends or whatever. This is not guys extracting value out of others. These are guys extracting value of economic value creation. All right? I hope you will understand that. Now there's everything you needed to know regarding this. I don't want to see any of those mistakes made ever again. The last I'd like to cover is I don't want to see a value investor arguing with a momentum trader. Both of these should never come close to each other. There's no overlap between the two. The momentum traders are entirely out when the value traders are in. So don't ever see a dispute between two guys. That means one of the two shouldn't be trading where it is. I don't want to see momentum dealing with value. And that's currently what I see, for example, in Ethereum, which is pure value. And I see momentum trader trying to gamble over it. So please, guys, don't do this. All right? This is a value stuff now. Don't fuck it up with your momentum. All right? Same thing goes in here. The VCs have nothing to do with growth. So when I see growth asset mentioning VC money, that means something is wrong. The VC money needs to be out already. Okay, that's for Solana, for example. Solana is not growth yet. There's still a hell of a lot of VC money in here. Be very cautious with that, all right? These are all the signs that you should get familiar with now, because I see a hell of people mixing things together, and I think it was dangerous. At least today I wanted to show it to you so that you understand those things fundamentally. That being said, I'm going to leave you guys with that. Bye-bye.